Something has fundamentally shifted in the precious metals markets, and if you hold silver or gold, or if you've been watching from the sidelines wondering when to act, what's happening right now deserves your complete attention. This isn't about price predictions. This isn't about getting rich quickly. This is about understanding a structural crack that's forming between two versions of the same market, one built on physical reality and one built on paper promises. Over the next 25 minutes, I'm going to walk you through what's actually happening beneath the surface volatility you're seeing in headlines. We'll examine why experienced investors are watching this moment carefully, what historical patterns tell us about periods like this, and most importantly, how to think clearly when markets are deliberately designed to trigger emotional reactions. If you already own precious metals, you need to understand why your position is being tested right now and what that testing actually means. If you don't own any, you need to understand why this volatility might represent something very different from what it appears to be on the surface. The difference between investors who build lasting wealth and those who get shaken out at exactly the wrong time often comes down to one thing: understanding the difference between noise and signal. Today, we're going to separate the two. Let's begin with what's actually happening. When you look at gold and silver prices, you're not actually looking at one market. You're looking at two markets that are supposed to track each other, but are increasingly showing signs of divergence. There's the physical market, the actual metal, the bars and vaults, the coins people hold, the industrial silver used in solar panels and electronics, the gold held by central banks. This is metal you can touch, store, and use. Then there's the paper market, futures contracts, ETFs, certificates, derivatives, and other financial instruments that represent claims on metal but don't require the metal itself to change hands. This market is exponentially larger than the physical market. Some estimates suggest that for every ounce of physical silver, there are hundreds of ounces of paper claims trading hands. For decades, these two markets moved in relative harmony. The paper market provided liquidity and price discovery. The physical market provided the underlying foundation. It worked more or less because trust held the system together, but trust is a strange thing in financial markets. It works perfectly until the moment it doesn't. And right now, we're seeing early signs that this trust is being questioned in ways it hasn't been questioned in years. Physical premiums are rising in certain markets. Delivery delays are extending. Refineries are reporting backups. Meanwhile, paper prices are experiencing volatility that seems disconnected from these physical realities. You're watching a market where the price can be pushed down while actual metal becomes harder to obtain at that lower price. This isn't conspiracy theory. This is how markets with heavy derivative exposure behave when the underlying physical commodity becomes constrained while paper positions remain enormous. We've seen this pattern before in other commodities. It never ends the way the paper market suggests it will. To understand why this is happening now, you need to understand the broader economic environment we're operating in. And that environment is unlike anything most investors have experienced in their lifetimes. Global debt has reached levels that previous generations would have considered mathematically impossible to service. Governments aren't reducing this debt. They're accelerating it. Every fiscal year brings new records. Every crisis brings new justifications for more borrowing. When debt reaches certain levels relative to GDP, countries face a choice: default explicitly, default through inflation, or attempt to grow their way out. History shows us that the third option rarely works. The first option is politically unacceptable, which leaves the second option as the path of least resistance. This is where precious metals enter the conversation. Gold and silver have served as monetary metals for thousands of years, not because of tradition or superstition, but because they possess qualities that make them useful when confidence in paper currencies begins to erode. Central banks understand this, which is why their gold purchases have accelerated dramatically over the past few years. They're not buying gold because they think it's a quaint historical artifact. They're buying it because they understand what happens when the system that's been built on dollar dominance begins to shift. Interest rates add another layer of complexity. When rates rise, the traditional thinking says gold should fall because it doesn't yield interest. But that assumption only holds in stable monetary environments. In environments where real rates adjusted for actual inflation, are negative or barely positive, the calculus changes entirely. You're living through a period where official inflation rates and actual experienced inflation are diverging for many people. Food costs, energy costs, housing costs, insurance costs, these are rising faster than wage growth for large portions of the population. That's not speculation, that's measurable reality. In this environment, assets that preserve purchasing power become more valuable, even if they don't generate yield. The question isn't whether gold pays interest. The question is whether your dollars are maintaining their purchasing power while sitting in cash or bonds yielding less than real inflation. While gold gets most of the attention as a monetary metal and store of value, silver occupies a unique position that makes its current situation especially interesting. Silver is both a monetary metal and an industrial commodity. It's used in electronics, solar panels, medical applications, water purification, and dozens of other industrial processes. Unlike gold, where most of the metal ever mined still exists in some form, silver gets consumed, it's used up in industrial applications, and often in quantities too small to make recycling economical. This dual nature creates unusual dynamics. When economic activity slows, industrial demand for silver can decrease, putting downward pressure on prices. But when monetary concerns increase, investment demand for silver can surge, putting upward pressure on prices. Right now, we're seeing both forces at work simultaneously. Industrial demand remains strong, particularly from the solar industry, which is using silver at record rates. But we're also seeing increasing investment demand as people look for ways to preserve wealth outside the traditional financial system. The silver market is also much smaller than the gold market. It takes less capital to move silver prices significantly. This creates volatility, which cuts both ways. Silver can fall harder than gold during sell-offs, but it can also rise more dramatically during rallies. The paper-to-physical ratio in silver appears to be even more extreme than in gold. The number of paper claims on silver compared to actual physical silver available for delivery is staggering. This creates a market structure where prices can be suppressed through paper trading while physical metal becomes increasingly difficult to source at those suppressed prices. We saw hints of this during the early stages of previous precious metals rallies. Physical buyers step in at certain price levels. They take delivery. They remove metal from the market. And eventually, the paper market has to reconcile with physical reality. The question isn't if this reconciliation will happen. The question is when and what triggers it. Markets can remain irrational longer than you can remain solvent, as the saying goes, but structural imbalances eventually resolve themselves. They always do. If you study market history, you notice patterns, not exact repetitions, but rhythms and cycles that tend to repeat because human psychology remains relatively constant. Precious metals move in long-term cycles, often lasting years or even decades. They go through accumulation phases where prices trend sideways or slightly down while informed buyers steadily acquire positions. Then they go through recognition phases where broader markets begin to notice and prices start climbing. Finally, they go through mania phases where everyone wants in and prices reach levels that overshoot fundamental value. We saw this in the 1970s when gold went from $35 to over $800. We saw it again in the 2000s when gold climbed from around $250 to over $1,900. Each cycle had different triggers, but similar patterns. The common thread in these cycles is that they don't begin when everything is obviously bullish. They begin when most investors are skeptical or distracted by other assets. They begin during volatility that shakes out weak hands. They begin when the narrative around precious metals is mostly negative and mainstream. Financial media dismisses them as relics. Sound familiar? Between major bull markets, precious metals can trade sideways for years. During the 1980s and 1990s, gold basically went nowhere for nearly 2 decades. Investors who held through that entire period saw minimal returns. But investors who accumulated during the dull years and held into the next bull market saw substantial gains. The lesson isn't that precious metals always go up. The lesson is that they move in cycles, and positioning yourself properly within those cycles matters more than trying to time exact tops and bottoms. Right now, we're in a period of extreme volatility. Prices swing dramatically day to day. Headlines shift from bullish to bearish and back again. This is exhausting to watch and even more exhausting to trade, but volatility itself can be a signal. Markets that are transitioning from one phase to another often experience volatility as different participants disagree about value. Calm markets reflect consensus. Volatile markets reflect disagreement and transition. The historical record also teaches us about the relationship between precious metals and currency debasement. Every major period of monetary expansion has eventually led to some combination of inflation, currency devaluation, and increased interest in hard assets. This doesn't mean gold and silver go straight up during these periods. They often experience severe corrections even within longer-term bull markets. The 1970s gold bull market had a 50% correction in the middle of it. The 2000s gold bull market had multiple corrections of 20 to 30%. These corrections feel catastrophic when you're living through them. They feel like the bull market is over. They shake out investors who are over-leveraged or psychologically unprepared. But in hindsight, they're often the best buying opportunities within the larger cycle. Let's talk about the psychological warfare that happens in markets like these, because if you don't understand it, you'll become a victim of it. Markets are designed to do 2 things: transfer wealth from emotional participants to disciplined participants, and from uninformed participants to informed participants. The mechanism for this transfer is volatility combined with narrative manipulation. When prices are falling, the narrative becomes overwhelmingly negative. Analysts appear on financial networks explaining why the asset is worthless. Articles get published predicting further declines. Social media amplifies the fear. Your brain, wired for pattern recognition and social proof, begins to believe the narrative. This is when disciplined investors buy, not because they enjoy catching falling knives, but because they understand that maximum pessimism often coincides with minimum prices. They're not trying to pick the exact bottom. They're accumulating positions when the risk-reward ratio has shifted in their favor. When prices are rising, the opposite happens. The narrative becomes overwhelmingly positive. Everyone has a story about someone who made money. FOMO, fear of missing out, becomes the dominant emotion. This is when disciplined investors become cautious or start taking profits. The challenge is that your emotions want you to do the exact opposite of what successful investing requires. You want to buy when you feel safe and confident, which usually means prices are already elevated. You want to sell when you feel afraid and uncertain, which usually means prices are already depressed. Breaking this pattern requires understanding that your emotions are providing you with contrary indicators. When you feel most afraid, that's often when opportunity is greatest. When you feel most excited, that's often when danger is highest. This doesn't mean ignoring your emotions entirely. Fear can be a valid signal that you're over-leveraged or invested in something you don't understand. But it means developing the ability to separate emotional reactions from rational analysis. Right now, anyone holding precious metals through this volatility is experiencing emotional stress. Watching your portfolio value swing dramatically is uncomfortable. It triggers doubt. It makes you question your thesis. This is by design. Markets need to shake out weak hands before major moves higher. If everyone who bought remained convinced and comfortable, there would be no one left to buy at higher prices. Volatility creates the uncertainty that causes some people to sell, providing the inventory that allows others to buy. Understanding this doesn't make it easier emotionally, but it does help you maintain perspective. The question you need to ask yourself isn't, how does this feel? But rather, has my thesis changed? Let's speak directly to those of you who already hold positions in gold or silver. This volatility is testing your conviction, and you need to think clearly about what it means for your situation. First, remind yourself why you bought in the first place. If you bought precious metals as a speculation hoping for quick gains, this volatility is exposing that weakness in your strategy. Precious metals aren't get-rich-quick vehicles. They're wealth preservation and long-term value storage tools that occasionally experience significant appreciation during monetary crises. If you bought with a clear understanding of the macro thesis, currency debasement, debt acceleration, geopolitical uncertainty, financial system fragility, then ask yourself, has that thesis changed? Are governments suddenly reducing debt? Are central banks suddenly pursuing sound monetary policy? Is global stability increasing? The answer to these questions matters more than short-term price action. If your thesis remains intact, short-term volatility is noise, not signal. It's uncomfortable noise, but noise nonetheless. Second, consider your position sizing. If this volatility is causing you significant emotional stress or financial risk, you may be overexposed. Proper position sizing means you can withstand substantial price swings without being forced to sell at the wrong time. If you're losing sleep, you're likely positioned too aggressively. The traditional recommendation is that precious metals should represent a portion of a diversified portfolio, enough to provide meaningful protection if the thesis plays out, but not so much that volatility becomes unbearable. Exactly what percentage depends on your individual circumstances, risk tolerance, and conviction level. Third, understand the difference between paper and physical positions. If you own ETFs or mining stocks, you're exposed to different risks than someone holding physical metal. ETFs can experience tracking errors, counterparty risks, or redemption issues. Mining stocks are leveraged plays on metal prices, but also depend on operational execution, political risk, and equity market conditions. Physical metal in your possession represents direct ownership with no counterparty risk. It's the purest expression of the precious metals thesis. But it also comes with storage and security considerations. Many experienced investors structure their precious metals exposure in layers: a core physical position for insurance, supplemented by paper positions for liquidity and potential leverage. This approach provides both security and flexibility. Finally, resist the urge to constantly check prices. Watching daily or hourly price movements will drive you insane and provide no useful information. The relevant timescale for precious metals investing is measured in years, not days. If you believed in the thesis enough to allocate capital, you need to give that thesis time to play out. This doesn't mean being rigid or refusing to adjust if circumstances genuinely change. It means not letting short-term volatility override your long-term strategy. For those watching from the sidelines, this volatility presents both opportunity and danger, often simultaneously. Let's think through how to approach this situation thoughtfully. First, understand that there's no perfect entry point. People who wait for the ideal moment often wait forever, constantly finding reasons why now isn't quite right. The market is too high. the market is too volatile. Better opportunities exist elsewhere. These, or rationalizations, can continue indefinitely, while the underlying conditions that make precious metals attractive continue to deteriorate. The alternative approach is averaging in over time. Rather than trying to time a single perfect entry, you systematically build a position regardless of short-term price action. You buy monthly or quarterly, in predefined amounts, following a disciplined plan rather than an emotional reaction. This approach removes the psychological burden of trying to time the market perfectly. You'll sometimes buy near tops and sometimes near bottoms, but over time, you'll build a position at an average price that's reasonable within the larger cycle. Second, start with education before making significant allocations. Understand what you're buying and why. Read about monetary history, study previous precious metals cycles, understand the difference between numismatic coins and bullion. Learn about storage options and security considerations. The more you understand, the more confidence you'll have during periods of volatility. Ignorant investors panic during corrections because they don't understand what they own or why. Educated investors view corrections as potential opportunities because they understand the underlying thesis. Third, be honest about your risk tolerance and time horizon. If you need this capital in the next year or two, precious metals may not be appropriate. They can remain volatile or even decline for extended periods before the larger thesis plays out. This is long-term positioning, not short-term trading. If you're young and focused on wealth accumulation, your allocation might be relatively small compared to growth-oriented investments. If you're older and focused on wealth preservation, your allocation might be larger. There's no universal right answer, only what makes sense for your specific situation. Fourth, consider starting with physical metal rather than paper proxies. There's enormous educational value in holding actual gold or silver in your hand. It makes the concept real in a way that seeing numbers on a brokerage statement never does. Start small if necessary. Even a few ounces teaches valuable lessons about storage, security, and the psychology of ownership. Finally, understand that entering a volatile market requires emotional discipline you might not realize you need until you're actually in the position. Buying during volatility means watching your initial purchases potentially decline further before recovering. This tests your conviction immediately. If you can't handle that psychological reality, you're better off waiting for calmer conditions, even if it means paying higher prices. The worst possible outcome is buying during volatility, panicking during further declines, and selling at a loss just before the recovery you were trying to position for. Let's be very clear about behaviors that destroy capital and create unnecessary risk, especially during volatile periods like this. Don't use leverage to buy precious metals. This is critical. Leverage amplifies both gains and losses, and precious metals are volatile enough without adding borrowing to the equation. What happens is predictable. You buy on margin during a rally, prices correct sharply, you get a margin call. You're forced to sell at the worst possible time, and you lock in losses while missing the eventual recovery. Experienced investors use leverage sparingly, if at all, and never in a way that could force liquidation during normal market volatility. If you can't afford to buy precious metals with cash, you're better off saving until you can, rather than borrowing to accelerate your entry. Don't chase price momentum without understanding what you're buying. When silver jumps 20% in a week, the temptation to jump in becomes overwhelming. But momentum trades work until they don't, and if you don't understand the underlying thesis, you'll likely exit at the first sign of trouble, which is often exactly when patient investors are adding. Don't follow social media hype uncritically. The internet has democratized access to financial information, which is valuable. But it's also created echo chambers where speculation gets amplified into certainty and hopeful predictions get presented as analysis. Verify claims, demand evidence, think critically. Some of the loudest voices online are people with small positions trying to pump prices to benefit themselves. Others are genuine in their beliefs, but dangerously overconfident in their predictions. Very few have your specific financial situation and risk tolerance in mind when they're posting their opinions. Don't ignore the tax implications of your trading. Every time you sell at a gain, you potentially trigger a taxable event. Frequent trading can create significant tax burdens that eat into your returns. This is especially true with physical metals, which may be taxed as collectibles at higher rates than other investments in some jurisdictions. Don't store all your physical metal in one location, especially if that location is your home and you're telling people you own precious metals. Security becomes a genuine concern once you accumulate significant positions. Diversify storage across multiple secure locations. Tell as few people as possible about what you own. Don't panic sell during corrections just because you see negative headlines or declining prices. If your thesis hasn't changed and your position sizing is appropriate, corrections are temporary volatility, not permanent losses. The only way to lock in losses is to sell. If you hold through corrections, you maintain the opportunity to recover and profit when the cycle turns. Don't stop learning and staying informed. Markets evolve. Conditions change. New information emerges. Investors who made one decision years ago and never reassessed can find themselves in positions that no longer make sense. Stay engaged with the broader macro environment without becoming obsessed with daily price movements. Step back for a moment and consider the bigger picture of why this entire conversation is happening. We're living through a unique period in financial history. The monetary system that's existed since 1971, a pure fiat currency system backed only by government promises and military power, is facing stresses it hasn't faced before. Global debt levels exceed anything seen outside of world wars. Central bank balance sheets have expanded to sizes that would have been considered impossible a generation ago. Currency debasement is happening simultaneously across most major economies. Trust in institutions is declining across much of the developed world. None of this guarantees that precious metals will appreciate dramatically or that the financial system will collapse. Systems can persist in seemingly unstable states for far longer than rational analysis suggests they should. Human ingenuity and adaptation are remarkable. But it does mean that the arguments for owning some precious metals as insurance have strengthened, not weakened. The probability that we experience significant monetary disruption at some point in the coming decades seems higher than at almost any point in the past 50 years. This isn't about fear or pessimism. It's about probability and risk management. You buy fire insurance not because you're certain your house will burn down, but because the cost of being wrong if it does is catastrophic. You wear a seatbelt, not because you're certain you'll have an accident, but because the marginal cost is tiny compared to the potential benefit. Precious metals function similarly in a diversified portfolio. They're insurance against monetary instability and currency debasement. Most of the time, they might not outperform stocks or real estate. But during the times when currency issues emerge or financial systems experience stress, they can preserve wealth when other assets are struggling. The current volatility we're seeing isn't a bug in this thesis, it's a feature. Insurance assets don't move in smooth, predictable patterns. They trade quietly for long periods, then experience volatile repricing when risk perceptions change. What we're watching unfold in the precious metals markets right now is the early stages of a repricing process. The relationship between paper claims and physical metal is being questioned. The sustainability of current monetary policies is being debated more openly. The role of gold and silver in a portfolio is being reconsidered by investors who previously dismissed them. This process won't unfold in a straight line. There will be false starts and corrections. There will be periods where it seems like nothing is changing, but the underlying fundamentals continue to point in a direction that favors hard assets over paper promises. The difference between successful long-term investors and those who struggle often comes down to perspective and patience. Successful investors understand that wealth is built slowly through consistent behavior over extended periods. They understand that trying to maximize every opportunity usually means missing most of them because you're constantly waiting for perfect conditions that never arrive. They think in decades, not days. They build positions methodically. They maintain discipline during both euphoria and panic. They focus on what they can control, their position sizing, their research quality, their emotional responses, rather than what they can't control, which is market prices in the short term. This mindset is especially important in precious metals because these assets test your patience repeatedly. They can trade sideways for years. They can experience sharp corrections that feel permanent. They can move in the opposite direction of what logic suggests they should do for extended periods. But patient investors who maintain conviction through these tests often get rewarded eventually. The market can ignore reality for a long time, but reality tends to assert itself eventually. Physical constraints exist, mathematical limits exist, economic laws exist, even if their enforcement is delayed. Right now, you're facing a choice about how to think about the current volatility. You can view it as a disaster that's destroying value and forcing you to react. Or you can view it as a temporary repricing that's creating opportunity for those who understand what's actually happening beneath the surface. The second perspective requires more work. It requires research and education. It requires understanding history and cycles. It requires emotional discipline and intellectual humility. But it's also the perspective that tends to lead to better long-term outcomes. None of this means being rigid or refusing to adapt when circumstances genuinely change. Stubbornness is not the same as patience. The difference is that patience is rooted in a well-reasoned thesis that you continuously evaluate against new information. Stubbornness is commitment to an outcome regardless of evidence. Stay flexible in your tactics while remaining committed to sound principles. Principles like diversification, position sizing, risk management, continuous learning, and emotional discipline. These principles work across different market environments and asset classes. If you own precious metals, your path forward involves patience and perspective. Continue to evaluate your thesis against new information. Maintain appropriate position sizing that allows you to sleep at night. Resist the urge to make emotional decisions based on short-term price movements. Consider using volatility constructively. If prices decline significantly and your position size is below where you'd like it to be, corrections can be buying opportunities. If prices rise substantially and you're overexposed, rallies can be opportunities to rebalance. The key is having a plan before emotions take over. Stay informed about the macroeconomic backdrop. Watch debt levels, central bank policies, inflation trends, currency movements, and geopolitical developments. These factors matter more for precious metals than most day-to-day market noise. They're the winds that eventually move the ship, even when daily waves create confusing motion. If you don't own precious metals yet and you're considering entering, take your time to learn before committing significant capital. Start small if necessary. Use dollar cost averaging to build positions over time. Focus on understanding what you're buying and why before worrying about timing the perfect entry. Remember that the goal isn't to maximize every opportunity or achieve perfect timing. The goal is to build appropriate positions that serve a clear purpose in your overall financial strategy, whether that purpose is wealth preservation, portfolio diversification, or insurance against monetary instability. For everyone, regardless of your current positioning, the most important thing you can do is remain educated and engaged without becoming obsessed. Check in regularly on the macro environment, reassess your thesis periodically, but don't let daily price swings dictate your emotional state or override your long-term thinking. The investors who navigate periods like this successfully aren't the ones with the most sophisticated trading strategies or the best short-term timing. They're the ones with clear thinking, appropriate positioning, emotional discipline, and the patience to let long-term theses play out without being shaken out by short-term volatility. Markets are designed to reward patience and discipline while punishing impulsiveness and emotion. They're designed to transfer wealth from those who can't handle uncertainty to those who can. Understanding this dynamic is half the battle. We've covered a lot of ground today, but the core message is simple. Understand what you own, know why you own it, and maintain discipline regardless of short-term market behavior. The volatility we're seeing in precious metals markets right now is uncomfortable, but it's not unprecedented. It's the kind of volatility that often precedes significant moves as markets transition from one phase to another. It's the kind of volatility that shakes out weak hands and creates opportunity for patient capital. The disconnect between paper markets and physical markets in gold and silver is real and growing. How this resolves is uncertain in terms of timing, but history suggests that physical reality eventually wins these battles. Paper can promise anything, but physical metal can only exist where it actually exists. The macroeconomic backdrop, unprecedented debt levels, ongoing currency debasement, geopolitical uncertainty, and declining trust in institutions continues to support the core thesis for precious metals ownership. These conditions haven't improved. If anything, they've intensified. This doesn't guarantee price appreciation in the short term. Markets can remain irrational or manipulated far longer than seems reasonable. But it does suggest that the probability-weighted case for holding some precious metals as part of a diversified strategy remains compelling. For those who already hold positions, this is a time for patience and perspective. For those considering entry, this is a time for education and methodical positioning. For everyone, this is a time to tune out the noise and focus on fundamentals. The coming months and years will likely bring more volatility, more uncertainty, and more moments that test your conviction. Markets always do. But if you've built positions thoughtfully, sized them appropriately, and understand what you own and why, you have the foundation to navigate whatever comes. Stay informed, stay disciplined, stay focused on the long term, and remember that the goal of investing isn't to be right about everything or to maximize every opportunity. The goal is to make good probabilistic decisions that serve your specific situation and financial objectives. The crisis isn't coming. The crisis is here. It's been unfolding slowly for years through monetary expansion, debt accumulation, and the gradual erosion of currency purchasing power. Most people don't notice gradual crises because they lack the dramatic moments that capture attention. But those who understand cycles, study history, and think probabilistically recognize what's happening. They position themselves accordingly, not with fear or panic, but with clear-eyed assessment of risk and opportunity. That's what this moment calls for. Not reaction, but response. Not emotion, but analysis. Not hope or fear, but preparation and patience. The investors who approach this environment with clarity and discipline will look back years from now and recognize this volatility for what it was. Not a disaster, but a test. And tests don't destroy those who are properly prepared. They reveal who was prepared and who wasn't. Be among the prepared. Stay thoughtful, stay informed, and trust that sound principles applied with discipline tend to work out over time, even when the path is uncomfortable. Thank you for your time and attention. Stay safe, stay smart, and I'll see you in the next video.